Welcome, everyone. I'm thrilled to be here for a fireside series operating under load growth, forecasting, interconnection, and grid capacity. I'm a professor at Yale Law School, and my research focus is on the regulations governing the grid and electricity market design. I'm joined by Brendan Milstein, Sean Kelly, and Antonio Conejo. And before turning to sort of a series of guided questions, I'm going to let them introduce themselves. So why don't we start with Sean?
All right. Thanks for having me. Appreciate the opportunity. I'm Sean Kelly, co-founder and CEO of Amperon. Amperon is a software that forecasts electricity demand, wind, and solar at the intersection of AI and energy data. And so we started the company in 2018 and have grown to on 4 continents, 26 countries, and have a little less than 100 employees. But appreciate the opportunity and look forward to the conversation.
Let's now go to Brendan.
Thank you, Josh. Hi, everyone. I'm Brendan Milstein, co-founder and president of Sentinel. Sentinel is a technology company that makes it very profitable for commercial buildings, so primarily office buildings, outpatient medical buildings, that sort of thing, to reduce energy use. We started in 2010. We have worked in a little more than 2,300 buildings in 46 states in the US, and excited to speak with you all today.
And finally, Antonio.
Well, thank you very much. I'm thrilled to be here, and I'm a professor of electrical engineering and industrial engineering at The Ohio State University. My expertise relate with the power system in general, how you operate, plan, and control them, and electricity market specifically. So very glad to be here. Thank you.
Wonderful. So the way that the sort of run of show is that I'm going to pose guided questions to the other 3 panelists and then one to myself. Our hope is that after each response, the other panelists can ask follow-up questions or we can move on. And then at the end, we'll have a deeper conversation or open questions. So Sean, if I can start with you, drawing on your background in energy trading and market integration of large assets, how can flexible large loads and behind-the-meter resources be structured to meaningfully alleviate capacity constraints without introducing new reliability risks or market distortions?
Yeah, thank you for that, and great question. I guess to frame it a little bit, I'll tell you a little bit about Amperon and my background. And so with Amperon, the thesis was we would build a software that helps you at a meter forecast what is going to happen over the next really 15 days. That's where a lot of the weather models lie, 360 hours. And so we now, fast forward, have about 40 million meters in the United States under management. And with that, we're telling sometimes on the individual meter level, sometimes in aggregate, what that next hour is going to look like, again, going out 15 days. We also have a 46-day, 7-month, and 5-year model. And so, again, just trying to help people figure out how to mitigate risk and hedge as much as possible. So with large load, the first large load we ever forecast was actually a casino on the Vegas Strip about 5 years ago. And so they were looking at about a 25 megawatt load, wanted to understand how to tie that in with the renewable offtake that they had in Nevada. And so we would go in, forecast that. We'll also look at the coincident peak. So coincident peak is each ISO, a lot of the utilities will have a program to incentivize you to not use power at the highest 15 or 1 hour interval of that said month or that said time period. So we're letting our customers know that as well. So these large loads are surprisingly flexible. I think we learned what demand response was in the early 2000s. Now most people are in demand response programs that have, really even above like almost 100 kilowatt loads, but definitely everything above 1 megawatt across the United States has the ability to flex down. And some things are more mission critical. They can only flex a little bit. And then some are like Bitcoin mining, which can go almost to zero. And so what we're giving them is telling them this is going to be a peak day. We also forecast the ISO, or for our European customers, the TSO, to go in and say these are going to be like the highest peak days, or this is a time when wind is going to be going down, or solar is going to be going down, or your particular asset. So with these large loads, we want to give them market knowledge, but also knowledge around their individual load so that they can be the best actors on the grid as possible. So this is obviously all anyone wants to talk about. And we just saw this with Winter Storm Fern, and PJM and ERCOT both were able to literally, like, PJM toggled down about 10 gigawatts more than expected from a large load standpoint. ERCOT was probably closer to like 7 or 8, but nonetheless, the large load definitely did its piece. And fortunately, a handful of those are Amperon customers.
So I have a quick follow-up question maybe before we move on. And so one thing that seems increasingly controversial is how you would structure mandatory curtailment rules for large load. Um, and from my non-technical but regulatory and economic background, it seems to me that there will be times if we really are seeing load increases where the current system is unable to meet demand in a given moment in time, which means we will have to face curtailment priorities. And one thing I'm hearing from new large loads is that if you curtail 1,200 megawatts at a time, the transformers will degrade or depreciate much more quickly than they would otherwise. And so a sort of question I have is, just as a technical matter, do we see challenges with curtailment or energy efficiency or demand response associated with large loads and maybe data centers in particular that have not been challenges in the past? And sort of maybe relatedly, do you think, if you could advise on what the optimal curtailment policy would be from an RTO, what would you suggest?
Yeah, I mean, I'll tell you, my background was as an electricity trader for 11 years, so also not an electrical engineer. And so looking at it from a transformer standpoint is less of how I am. I think that, I mean, going to your legal background, we need to put this out in front of people ahead of time. And you are seeing large loads getting bumped up in the queue, saying that they'll be on good behavior, for lack of a better term. And so I think that's very interesting. I'm also an advisor to Emerald AI, which is a really interesting company that's really focused on large loads. Varun Sivaram's done a great job of that. And so with that, I feel that there are people who are going to get bumped up in the queue because they say, hey, we're going to be on good behavior. I am fortunate to have Tim Healy on our board. He was the co-founder and CEO of Internoc. I really think what we're going through with data centers is the same thing that he went through. And I mean, he started that company in 2001 and had to teach people what demand response was. He spent a lot of money on lobbying. I think we're going to go through that again. I do believe that in the early 2000s, if you went into Coca-Cola and said you're going to have to stop bottling these hours, they would have probably said you're crazy. Now everyone flexes down for demand response. I think that we're going to look back in 5 or 8 years and say, you know what, like, all the data centers can be responsible as needed. I'm sure there's transformer issues, but I think that getting out in front of it, also from a queue management, there's some transformers that are significantly more burdened. And then there's some that are used to it, some that are tied to like old smelting factories or coal plants that are like, okay, we've done this before. Coal plants have tripped off before to the tune of gig plus. And so we've seen all this happen before. So I think that some of the things we don't know yet. But I very much believe in a handful of years, we're going to have a bunch of data centers to go ahead and win, or worst case, be competitive in the AI race. And then we're going to be able to look back and realize that we paid attention to the price signals. We paid attention to the CP. We even paid attention to individual transformers that were overloading because maybe wind dipped down and they were tied right there. And so needed to have them back up accordingly because the generation behind them wasn't doing what we hoped it would. So yeah, I think it's an interesting time. The other thing too, I started trading in 2005. Now this is all anybody wants to talk about. The first 19 years of my career, nobody cared. So I do appreciate the fact that we are now dinner table, late night talk show. We're all over the place. So it's fun to be the cool kids finally.
Enrollment in my classes has definitely gone up.
Oh yeah, it's wild.
I want to chime in. I'm a physicist by training, which is actually the very wrong type of scientist to tackle this problem because stuff like heat degradation is exactly the type of thing physicists ignore that someone like Professor Conejo does not get to just ignore in electrical engineering. But I'm glad, Sean, you mentioned lobbying because I think there's a really important marketing dynamic, or sorry, markets dynamic that is actually going to overpower anything technical here. So the rule of thumb, like obviously there's variation by location, but generally utilities cost on the order of $3 a square foot for a building. The rent the building pays is $30 a square foot. The salaries of the people in it are $300 a square foot. For something like a data center, obviously Google and Microsoft and OpenAI are not exactly publishing these numbers, but I would be shocked if the revenue was not way more than $3,000 a square foot and probably more like 30. So the idea that a data center will curtail because the grid asks nicely, I think is not going to happen. These companies will either figure out how to lobby or they'll install $30 million of batteries, whichever is cheaper, but that's going to be their option. They're not going to shut off Gemini because the grid asks. And so I think the consequence of that, I would like to see batteries. That would be great. Lobbying is probably cheaper. And so I would guess everyone else is going to need to curtail, and that is going to be an interesting dynamic to watch because those companies have enough money to win that fight, whereas much lower margin businesses do not. So I think it's going to be really interesting to see where the curtailment is forced in response to the hyperscalers. Call me cynical, but that's my hot take on that one.
I like it. We did see actually decent curtailment during Fern, which I was pleasantly surprised with. But yeah, they still have a very, very high price tag, as opposed to like you can figure out the exact compute cost of like Bitcoin, for instance, and figure out like what that magic number is that they're gonna stop using their compute.
Antonio, do you have anything to pipe in, or should I move on? Oh, I think you're all right. In that case, if it's all right, I'd like to turn to Brendan. Drawing on your work aligning landlord incentives, tenant savings, and performance-based service models, how should utilities and grid operators think about structuring programs so large building portfolios can provide measurable, dispatchable load flexibility rather than just passive efficiency gains?
Great. Thank you, Josh. And I'll answer this in three parts. The first, I'll just give a 60-second overview background on what Sentinel is, so everyone knows my lens and biases. Then I'm going to hammer on data, which is actually hard to say that quick. And then after that, I think we'll have the ground laid for pretty simple utility policy advocacy, which will be another hot take. So I want to share, first of all, the problem Sentinel solves and why we exist, because everything else flows from that. So let's see if we can overcome screen sharing technology here. So Sentinel does two things. Did this update, by the way? Is it now a different slide? Great. Okay. So we do two things. First thing we do is reduce operating costs in buildings, primarily by reducing utility costs. And again, this is commercial buildings. And the second thing we do is solve what is called the landlord-tenant split incentive. So most most commercial buildings are third-party owned, which means a landlord owns the building and leases space to the tenants. And in most of those buildings, there is something called the landlord-tenant split incentive. And the issue has to do with lease details, but in short, the landlord has to pay for any project that would reduce costs, but all of the savings go to tenants. Landlords are not charities, so unsurprisingly, there is just a huge wealth of energy efficiency opportunity available in these buildings. these buildings represent well north of half of commercial and industrial buildings in the US. So this is an important problem to solve. So that's why we exist. Started in 2010, done this in 2,300 buildings. And let me skip forward quite a bit. This is the short version of how we solve it, which is these are smaller buildings now. So like 20,000 square feet to 200,000 square feet. So these are generally, Sean had mentioned that 100 kilowatt kind of threshold for demand. These are anywhere between, call it 40 kilowatts and 250 kilowatts. So very much flirting with that boundary of where they have or have not entered into a demand response program. Most of the buildings we work in have not. So we're able to provide a financial mechanism that splits the savings and actually gets all of these projects unstuck. So that is what we do, why the company exists. And now let me talk about data, which I love so much. Okay, so this is what our program looks at like at scale. So we have a customer here who's done 417 different efficiency projects across a portfolio of 148 buildings. This is a publicly traded REIT, so very much under investor scrutiny to only do profitable things. And here's the results. They have invested more than $10 million in efficiency projects. And because of our financial structure, we pay them $2.5 million per year in rent. So this is new top line income that all of these buildings get to justify this quite large upfront investment. So this is a far market return beating investment, and I'll show you how and where this comes from in a moment. And tenants get 1.1 million per year in savings as well. So this is what it looks like at scale. And now I want to talk about data. So energy efficiency, I don't know how to say this politely, so I will say it bluntly. For the past 50 years has been woeful with regards to overpromising and under-delivering. So it is very important to us as a firm, since we sell a financial product, to actually measure the results. So what this is for the same 150 buildings, the energy use intensity of every building before and after projects. And we can see this average 20% reduction across the entire portfolio. And I want to point out how smash you over the head obvious this result is. This is really, really important. And I'm just going to throw my industry under the bus. If you can't provide smash you over the head obvious results from the customer's utility bills, you're not worth anyone's time. Like this should exist for every building, for every portfolio, and it does. Here is another one from an individual building. So you can see it's a little bit more noisy, but like importantly, they did the projects in February of 2025. You can see the exact moment the trailing energy use starts coming down. And I love this chart because it's so obvious. Each dot is the trailing 12 months. So it just makes all of the noise of utility bills disappear. We also forecast, if I can draw your attention to the energy performance column, this is the last 12 months of savings divided by the prediction. So this building was 7% under, this building was spot on, this one overperformed, 7% under, whatever. And if we scroll way to the bottom here of all of these buildings, let's go down, you can see on average, things are about 2% better than predicted. So this is what I mean by data. All of this stuff should be measurable. And I'm going to I want this in your brains because it's really important for utility programs, which do roughly the opposite of this in almost all cases. Before moving on to utility programs, I just want to share what a project is. Where do these great results come from? So what you are looking at here is time series data from RTU from a building before we helped them implement a project. And what you're looking at is just pressure data. This is the pressure in the ductwork. They're running about an inch of water column all the time. This is totally normal, except it's all the time. And if you actually look at the BMS, what it shows is this. So the BMS looks well scheduled. This is the control system. I'd maybe haggle that this air handler needs to come on at 4 a.m., but the important thing here is it's coming on in the morning, it's turning off in the evening. But that is not what the data shows. The data shows it's running all the time. And if we back out, we can see the exact moment that the contractor was brought in to fix the broken relay in the building management system. And now you can see it following that schedule the way it should be. This is what a project is. This is how the returns are so high. We're not replacing major equipment. We're fixing broken stuff in control systems so that things that are on at night that are supposed to be off become off. So that's what we do, how we do it. And when I say data, this is what I mean. We measure flipping everything. We measure the utility bills. We measure the pressure and the ductwork. We measure the current going through things. We do all of that with little sensors like this that we install in buildings. These are very cheap now because you can just send off the designs to China and they send back the boxes. That's amazing. When we started the company, those were like $2,000 a pop. Now they're like 40. It's shocking. So data, it's easy to reduce energy use in buildings. It should be measurable and really smash you over the head. Obvious what happens. And if it's not, I would highly encourage you to be ridiculously skeptical. So with that as background, what should utility programs do? Okay, utilities have, for the most part, two different types of programs. Deemed savings, where they say, on average, if you replace the lights, you'll save about this much. And they have, quote, a custom retrofit incentive, which is where you calculate what the savings will be. You agree with some third-party engineering firm, which is often low bid and often terrible. Some of them are fantastic. There's a very large normal curve there. And then the measurement of the savings is just someone goes and checks that the equipment was in fact changed. So these are fraud prevention. They don't want to spend $2 million on a chiller replacement to find out no chiller was replaced. So that's how it works today. How should it work? You've just seen all of the data. So I would, if I had a magic wand, I would immediately eliminate every single utility incentive program that exists, except things that are actually performance-based. So actually performance-based means we're going to look at the utility data from before the project and after the project and pay 5 cents a kilowatt hour, and that's it for savings. That is how every utility program should be run now. These were designed in the 70s where there was not smart meters and you had 12 data points per year and that was it. And 3 of those might have been made up, followed by a true up reading. Whereas now we have a reliable 12 data points at a minimum and often thousands. And we should use that data. And if you can't show it in the utility bills, you shouldn't get an incentive. And if you can, why on earth would the utility care have? So that's how I would run the efficiency programs. And then to make them dispatchable, I would add a kicker for demand response. And the kicker here is important, which is for these small buildings, demand response revenue often doesn't nearly cover the controls upgrades required to facilitate it. So I would pay for this stuff with efficiency, but then I would add a kicker for dispatchable controls. For these large buildings, we have a lot of opportunity. For the small buildings, we don't. However, if it's combined with a performance-based program, I think you could get mass numbers of these smaller buildings contributing, which is a very large percent of the load. And that's it. That's how I'd run it. Use the data, pay a kicker, done.
So I have a question, but Antonio, I see you're not muted. So do you want to go first or?
Yeah, perhaps just a very quick question is, have you applied this to a data center? Do we have room for actually improving efficiency in a data center? What I believe will be an interesting connection, right?
Yeah, great question. We have done data centers. I will split these into 2 types. There is a ground up build the building was designed to be a data center from the beginning. And then there's what I'll call legacy, which is it used to be an office building or warehouse, and now it's a data center. The legacy data centers have a lot of opportunity. We're in the West Coast data center for the New York Stock Exchange, for example, because that used to be an office building in San Francisco and then was converted. Power utilization efficiency, PUE is the metric. You can just bifurcate these. The legacy ones generally tend to have a PUE that's above 1.5. And if that's the case, we can get really significant savings, call it 20, 30%. Things that are ground up, we don't bother with at all. The PUE is like 1.04. They are shocking marvels of engineering and just beyond impressive, and we don't work with them. And kudos to the design teams on those things.
So I have maybe two questions. One is, at the end of your talk, you mentioned how you would reform utility regulation. But one thing that occurs to me is that the value you can capture probably does not reflect, or the value you can monetize probably does not reflect the value you're providing to the system, largely because of retail rate design. And I'm wondering, one, um, does the business case to you guys depend on differences in retail rate design? Do things like time of use pricing or energy efficiency programs matter to you? And relatedly, um, do you see regional or statewide differences in terms of where it makes sense for you to go in based on the fact that state regulators tend to smooth out retail rates, and don't provide well-designed energy efficiency or demand response incentives?
Yeah. Oh, what a great question. The retail rate smoothing, the way you're describing, impacts things a lot. And we see it, we have projects in Hawaii where the retail rate is 40 cents a kilowatt hour, blended average. And we have projects in rural South Carolina and rural Kansas where it's like 4 cents. And I think we have some third-party supply in Florida that's at 2 cents, which I don't even want to guess at how they're providing that. Um, we have been very careful to set the company up, and this was a decision we made in 2009, to just make sure it worked without any regulation or incentives or anything. This was coming off my former work for New York State government running an efficiency program and my co-founder's former work building a solar program, which obviously in the 2000s was extremely tax dependent. Um, so for us, we just made a choice to only focus on things that didn't need incentives, and hence the fixing and upgrading control systems. Um, the average return on investment to customers has been 60%, so extraordinarily high. We are definitely leaving total savings on the table. So we've bound ourselves to this very fast payback thing. Maybe in Florida at 2 cents, it's actually an 18% return. Maybe in Hawaii, it's like a 200% return. But we're getting an average of 20% whole building savings. I think if we pushed the bounds, we could probably get 30% in either higher rate regimes, or if we figured out how to actually tap into the piecemeal, rapidly shifting utility programs that exist, which has long been a weakness of ours.
All right. So if there's no other questions, I'm going to shift to Antonio. Drawing on your work in market clearing algorithms and transmission planning optimization, what structural reforms to interconnection and capacity accreditation frameworks would most effectively reduce queue backlogs while preserving economic efficiency and reliability under accelerated load growth?
Yeah, thank you, Josh. I think this is a very complicated question, but let me try to focus on something that perhaps we didn't pay full attention till now previously, which is the dynamic component. So what we have, if the capacity, if the demands grow, we have to increase the capacity, the generation capacity through a market mechanism, which is the way it works in most places. Of course, if the demand is away from the generation, we need a transmission system that has to be increased in a regulated manner because it's affect everybody. But I think the critical point here is that data centers and those gigantic load, they behave in, let's say, not particularly nice way. So due to economic incentive, they may change in a dramatic way quickly in a particular location and increasing in one particular location and decreasing in another one. Let's say data centers in central Ohio may lower the demand very quickly as the time that data centers in the region of Chicago, they increase dramatically the energy. And that might be because a minor price difference, as Brandon was mentioning. So why not? If there is a price difference, I'm in a market, so why not to do what is better for me? It's my obligation also. So my point here is that this kind of drastic behavior You may lose a generator, or you may lose a line. That's okay. But this is a kind of combinate effect of increasing the load dramatically in a particular location of the network at the time that you decrease or increase elsewhere in the network. And this produces a dynamic behavior of the system, which is it may create serious trouble and eventually blackout. And I think this is a critical component here, and what is really new, because I mean, demand grow, we produce more generation. That's what we have been doing all the time. So the way to add generation shouldn't be different than the way we have been adding generation in the past. So it's and basically it's a market driving decision nowadays, right? And the network, since it's something that you modify the network, it may affect everyone using the network. So we need to have a regulating mechanism to expand the network. But again, the fact that there is a very big load elsewhere or here, this doesn't make any big difference. Maybe it's just a different scale, but I don't think the regulation, the engineering knowledge to understand what is the process of increased generation capacity, or the process of increasing network capacity, I don't think there is any change there. So we may ask the regulator to be efficient and to be and to actually do their job in a timely manner, in a coordinated manner, taking into account everything. But there is no significant change in what we have been doing, at least during this century, with a significant amount of renewable, because renewable, of course, complicate this dynamic stability issue. So what I think is really relevant, I believe some important, a lot of colleagues in the power sector think that this is an important component. So we have a dynamic element here that introduce instabilities in the system. And this is first not well understood at the level of magnitude that we are referring to in the case of data centers. So and we had to understand that deeply from the engineering point of view, and then based on that, we had to produce regulation that allow us to operate the system in a secure manner. So in summary, I think we had to look at the dynamics. So not just how big is the change, but what is the speed of change that we are experiencing. So the acceleration component of what we are doing here is a critical component that may drive the system to instability in a simple way. This is what happened to some extent in the Iberian Peninsula in Europe. In last, I think it was last summer, before the summer, in April, something like that. So it was mostly motivated by a situation like that one, related not only with the actual energy that we move, but with the reactive power that is like something else that we had to deal with, and basically is much more unstable because the behavior is much more nonlinear, which means that it may change things very quickly, very rapidly. So that's it. Thank you.
John or Brendan, do you have follow-ups?
I'm curious. I obviously you don't know the answer to this, but I would love to hear you speculate. Do you think we're going to start having larger scale brownouts and blackout events in the next 10 years compared to kind of the baseline we've had the last 20?
I trust the engineering profession. I think sooner or later we end up producing appropriate solutions. So I think those solutions, I believe, are related with good behavior of sound demand. But the good behavior is not, it does not come from economics, right? There's no reason for that. It has to be somehow develop some kind of regulation that force the data center of gigantic load to follow certain rules that do not endanger the operation of the system. But I think we should be able to find the solution, yes.
So I spent a lot of time writing various resource adequacy papers after Uri and Elliot, and every time I'm really happy to be hearing from you in large part because I'm just curious, what do you think of as the areas where load growth will produce increased risk of blackouts? Like if you could name two or three, for those of us who don't have as much of a technical background as you, what are the things grid operators and regulators should be focusing on? And do you think NERC has the capacity and ability to do this, or do you think that, sort of building on Brendan's question, there are vulnerabilities that regulators are not thinking about?
Well, I think NERC is very well aware of what is going on. So probably they spend a lot of time, for instance, analyzing the case of the blackout in the Iberian Peninsula. So I think they are aware. So I think the important component, in my view, is the combination of renewable in place when you have a lot of renewables and this massive, gigantic load. So I think we have to understand the behavior of the renewables to be able to include within the power electronic that actually drive this renewable appropriate safeguard to make sure that they operate safely. And there is still some research to understand this and to do this better. But I think the technical community is working on that, and the technical community also working on what is the effect of major changes associated to gigantic load. So I'm optimistic in terms of technically. I think sooner or later maybe we experience some kind of blackout, but sooner or later we will be able to incorporate safeguard guardrail that allow us to keep this safely. Of course, we are talking about economics as well, because if you include security, means that this costs money. So the profitability is going to be down. So it has to be done. It has to be a regulator, the one actually doing that. And I think NERC has the expertise and ability to understand and to do that. Yeah, hopefully.
Yeah, I mean the blackout that they had in Iberian Peninsula, I think it was like late April or like early May. It wasn't even like a time of like extreme weather. I mean, like we just experienced here across, I think 35 states had record highs across the United States during Fern, or record lows during Fern. And so it's crazy that it can just happen then. And yeah, asset level wind and solar forecasting very difficult. And we've learned, we do this in a bunch of countries. Weather vendor is actually not necessarily good in all of the different geographies. And so like we just started tracking like Saharan like from one of our weather vendors and how that affects like the solar community over there. And I think it's like Greece and like Greece, Italy, something like that. And so there's a whole lot going on and a whole lot going into that. I guess my one question for you is, a 9 gigawatt plant in Ohio possible from a transmission standpoint that just got announced, or is that a marketing standpoint? Because I don't know if 9 gigawatts of combined cycle in one spot. I'm having a hard time figuring it out personally.
I don't know the details. I think we had to ask AP. I guess AP should be behind that, PGN. But I mean, they know what they are doing. So if they are announcing, I think they are doing that with engineering knowledge, I would say. So
yeah,
it
seems like a lot to be in one, a lot in one place.
Yes.
Well, if there are no questions, I guess I've been asked to talk about what legal or regulatory changes would best align interconnection policy, capacity market rules, and cost allocation with the realities of scaling data centers and other high-demand industrial loads. So this is a big question that I don't think I will be able to answer in 4 to 6 minutes. But maybe at a high level, I want to talk about this sort of, I think the 4 or 5 core areas that regulators should focus on. The first are policies that would make it possible to get resources onto the system more quickly. The second is resource adequacy rules that provide appropriate incentives to perform when needed. And I'll get into why some resource adequacy rules have not always created the right incentives. The third is can we build enough transmission capacity to accommodate the resources we needed? And maybe the fourth is uh, how do we are there ways to improve utility incentives so that we're not overpaying for things we don't need? We're creating incentives for not just excessive capital investments, but also whether when energy efficiency or demand response or other alternatives are available. So starting with how do you get resources onto the system? Um, we have very, very lengthy interconnection backlogs. If you're a generator, if you're a developer and you want to connect to the system, you submit an interconnection request, and then there are very, very lengthy studies. And under current FERC regulations, you can connect to the system in one of two ways: NRIS and ERIS. NRIS refers to Network Resource Interconnection Service, and ERIS is Energy Resource Interconnection Service. And so for the most part, resources connect through NRIS. And what this means is that the interconnection study um, involves determining whether the resource can actually deliver electric energy across the region or node or zone such that it can um, will not lead to stability issues. And going through NRIS means if you're in a capacity market region, you're entitled to capacity market payments. It means across the country, especially in ERCOT, which relies primarily on an energy market, you're not subject to curtailment risk. But to the extent possible, we should, sort of, Tyler Norris has been sort of well known for popularizing a connect and manage approach. It would be helpful to let resources connect more quickly if they're willing to forego resource adequacy payments and accept the risk that they will be curtailed or shut down when it would introduce stability issues. In other words, if we could just shorten the line, if resources accept certain risks, that is one way to get resources online quickly. A second reform related to that is we should, right now, we go through the interconnection queue basically sequentially. You submit a request, and the transmission owner or grid operator gets to you after it gets to everyone else. Various FERC reforms have tried to cluster interconnection studies, but it would be worth seeing about whether there are ways to identify resources that can provide greater value to the system. And I think there are two ways of doing this. One is we should auction off interconnection positions. And so if a resource expects to make more money in the capacity market or be compensated for various reliability services, it would be helpful to let certain resources bid to jump the queue. And we've seen in the last year a variety of approaches that would identify resources that contribute to reliability, but they're based primarily on administrative assessments that this resource really will help to keep the lights on. And I think it would be preferable to have developers put their money where their mouth is, such that we have a better sense of who's delivering value to the system. A variant of that is rather than auction off interconnection positions, we should have grid operators identify parts of the system that are likely to experience load growth or reliability challenges, prospectively build upgrades there, and then have essentially a subscription model where developers pay a flat fee that covers the interconnection upgrades. And both the auction approach and the fee model would, I think, help us sort of prospectively plan where upgrades are needed. Turning to the second area, why do our resource adequacy markets persistent? They're very expensive. They're more expensive by the day, but they haven't always sent proper economic signals. So this gets a little bit wonky, but for years, if you were in a capacity market, there was fairly good evidence that you were being overcompensated for not delivering when needed. And there are two reasons for this. One, so when you clear a capacity market, you're compensated for being available to sell energy. You're not being compensated for selling it. And so we have to predict, are you in fact able to sell energy 3 years in the future during moments of peak demand? And one of the things there were a couple problems with capacity market, most of which the recent reforms, especially in ISO New England, but also in PJM, have improved this, are that non-performance penalties were too low. And so if you cleared the capacity market, but paid very, very low non-performance penalties, you had an incentive either to overestimate your capacity contribution or to underinvest in things like winterization or preparedness for extreme weather events. And so it seems there is some evidence that we were overcompensating resources despite not actually sending good economic signals to make sure that they deliver when needed. Relatedly, this is also being changed. But one way we would do a capacity accreditation is we would look at something called performance assessment hours or performance assessment intervals, where we'd say, what are the 30 hours where we had the most scarcity or the biggest peak hours in the last few years? And what was the odds that you were able to contribute during those hours? And two things have become apparent. The first is that 30 hours is just too many hours. The 2 or 3 coldest hours or hottest hours of the year may not look like the next 10 hours. And so we were often compensating resources, even though those were not the most important hours to be compensated for their reliability contribution. In other words, we were taking a too large sample of hours. And second, we were not doing enough to look at correlated failures. As the resource mix changes, whether you were available 5 years ago may not be useful information in terms of predicting whether you'll be available in the future. Now, we've reformed both of these things in some respects. We've shifted to effective load carrying capability approaches, we've increased non-performance penalties. But as we've increased non-performance penalties, we've only marginally done things like impose hedging requirements and margin requirements on generators, meaning that as non-performance penalties increased during Winter Storm Elliott, we for the first time saw generators default and be unable to pay the non-performance penalties levied because they didn't meet their performance obligations. And so I think it is very, very important that if we are going to rely on various resource adequacy markets that predict whether you will in fact be available, that one, we are looking at when do we really, really need performance from these resources. Two, that you pay meaningful non-performance penalties if you don't meet your performance obligations. And three, that we turn to financial arrangements, margin and hedging requirements, capital requirements to make sure that resources can actually pay non-performance penalties. So if we are worried, can we get resources onto the system? I think it is a bad idea to do this without reforming resource adequacy markets to make sure we're sending good economic signals that incentivize performance. The next thing is if we are worried about, we have one reason the interconnection queue backlogs, looking back at 2005 and 2008, were shorter than they are now, is we had excess transmission capacity. And so it would be preferable not to rely on the interconnection queue and sort of local reliability upgrades to make most of the transmission and distribution upgrades needed to accommodate load growth. To the extent we can do regional and interregional transmission planning that is forward-looking, we would likely increase headroom and reduce both interconnection delays and make it easier for resources to get onto the system. Last two very quick points are one, and this is sort of so obvious it hardly bears mentioning, but it is very, very hard to deal with permitting and siting issues in the United States. And to the extent there's congressional appetite for permitting reform, that would also help. And then finally, utilities for the most part are compensated for making capital investments. And so this panel has had a great deal of discussion on, maybe there's room for energy efficiency, for demand response. But if you're a utility and you know that you get an 8% return, if you spend $100, you make $8, and if you spend $1,000, you make $80. $100, you make $8. You would way prefer making transmission and distribution upgrades and not looking to alternatives like grid enhancing technologies, reconductoring, and energy efficiency programs. I am not the person who should say this is the right amount of energy efficiency. But I do think it is a problem that the way we regulate regulated utilities means they will prefer to make capital investments over alternatives that reduce their own capital costs. And so I think, Brendan and Sean both mentioned performance-based regulation. I think that would be helpful. I think one way to sort of supercharge performance-based regulation, though it's a heavy political lift, is to say, let's take the distribution company and separate ownership from control. So the distribution company operates but does not own the infrastructure, meaning it's compensated on performance, but is not worried about things like stranding its distribution investments. It just wants to improve reliability and reduce costs. I think that would be a better way to align utilities incentives with the sort of our interests in keeping costs down and improving reliability.
I just want to piggyback on this last set of comments from you because I think it's so important and not said plainly nearly enough the way you did. And even the regulators have tried a lot of things, I think very poorly, obviously, here. But they're like, oh, you get a 12% return from efficiency, but 8 from everything else. It's like, cool. I would way rather get an 8% return off $1 billion than a 12% return off of $30 million. Like, there cannot be a more obvious decision there for a CEO, and I think it is the discussion around this is laughable. So I'm really happy to hear you have stated that plainly, and then the performance-based system you described, I also think would be great and also agree would be a big political lift. So I just wanted to say I thought that was all very well said and not said frequently enough. So thank you.
Well, I appreciate it. And if I can wonkify it even more or put on my pointy-hatted academic hat, I think what you said is totally right, but I want to draw out a few strands. So giving a couple 100 basis point adder for reducing costs, one, as you point out, it's just peanuts when you look at the magnitude of potential investment, billions and billions of dollars you can get by spending more. Two, if you're a utility and you show your regulator you can reduce costs, you are very, very worried about stranding assets. And so to the extent that you get cost recovery, the depreciation is calculated over a 20-year period, you really, really worry that you get a couple $1 million more for some energy efficiency program, but the risk is that you then have the regulator deny cost recovery for investments you already made. And finally, Jean Tirole won a Nobel Prize in part for work with Pierre Lafont, in which he wrote about something called the ratchet effect, where he said if you're a utility and you show, look, we can reduce our costs, you're really, really worried that the next time you have a rate case, they say, we'll reduce costs more. And so you may actually prefer to shirk because disclosing whatever headroom you have to improve efficiency in the system may end up causing the utility in a sort of repeat player game theoretic dynamic to increase the stringency of the regulatory incentives in the future.
Yeah, a quick addition. I would like just to mention that I think nowadays we have the appropriate technical tools to actually represent the physical reality in a very accurate manner and the computational resources to make this representation with fidelity. And most of the tools used by regulatory bodies, actually, they do not use that tools, but they use old-fashioned tools that, or traditional tools, or well-established commercial tool that not necessarily represent the reality in a very accurate, precise manner. So just to mention that the tools are there, they are computationally viable, and we can use, and we should use them for doing new regulation.
Antonio, one thing I'd just love to ask you, and I'm going to have to run soon, but it's just, I hear that utilities are really, really opposed to basically improving various ways they can get data on that would sort of help things like grid enhancing technologies and reconductor, and how much excess capacity does their own transmission and distribution lines have? And I'm wondering if you have a sense of like, why is it the regulators that are resisting this, or the utilities, or some combination?
Well, I cannot help with that. Sorry about that.
So
No,
you're
really.
not a law
No,
professor. You,
it doesn't look like right, because why
yeah,
not?
yeah.
I mean, data and clarity is good for everyone to make good regulation, and unless there is some economical incentive, but it doesn't look like a clear one in this case, right?
Yeah. I guess the problems with law professors is we don't know anything, but we're willing to opine, whereas you're the opposite.
Think a lot of what happens in the utility space is um, I don't know how to, like a political issue, not referring to politics, but referring to human dynamics. But this is a regulated monopoly, where as long as you do what everyone else is doing, you are guaranteed a profit. And the private sector is extremely risk averse to begin with, and regulated monopolies are even more so. And if you spend $50 million or $100 million on sensors that aren't proven and it doesn't give you a good outcome, you look like a fool. And if you do the same thing that everyone else does and your grid dies in a polar vortex the way everyone else's does, there is zero consequence to you or your golden parachute. So I think there's a strong incentive against first moving in any way that is different in regulated monopolies. So I don't know this obviously to be the case, but I am strongly suspicious of that since I can't come up with any other reason people aren't doing this.
That's absolutely my impression too.
Josh, can I ask you one more question before we go?
Yep.
You mentioned the idea of just auctioning off the position in line for interconnects, which
Yep.
I love. I have heard so much grumbling about those positions, how those positions are done in lines, and I haven't heard that as a solution. Can you just share, like, is this your idea? Is this broadly supported now? Like, just how is this? It seems so obvious once you say it, but I haven't heard it before. I'd just love more context there.
So I'll maybe make this apply. So I'm working on a paper with Jacob Mays, who's at Cornell he's an engineering and finance guy, on how to auction off interconnection positions. Um, there are, and I can speak at a high level. I think parts of it are obvious, right? We should just auction it off, and it may be as simple as that. There are auction design issues that to do it well would be complicated, right? Like there are some parts of resource adequacy markets that are sort of shockingly stupid, and one is the lack of harmonization between the interconnection queue and the capacity market delivery period, right? So you get paid to enter the market in 3 years, but you can't get through the interconnection queue for 5 years. And if the interconnection queue is pegged, the price cap is the cost of new entry, but new entry cannot possibly enter the market in time to get revenues from the capacity market. We have bifurcated the market and it's not sending a signal for new entry. And so a well-designed auction, in my opinion, has to think about how do you harmonize the timing with the resource adequacy market. So I think it should be much easier in ERCOT. It's one of the surprising things about ERCOT is it's actually just administratively easier when you have an energy only market to deal with some of the other things. Um, when you have a capacity market, you could still auction it off. I am sorting through some of the details about what the auction would look like. How much do you want to have? But I think even a kind of dumb version of an auction is probably better than the status quo. Um, my understanding is Colorado has done a little bit of it, while also doing a sort of handout to some of the vertically integrated utilities. Some people have quibbled that an auction would be inconsistent with open access requirements. That's clearly wrong. I don't know where that's coming from. Uh, it may not be worth going into here, but I don't know why it hasn't been floated so much. You could also, I mean, this it gets into like auction for everything, but you could absolutely auction off load interconnection too. Like if we think that we should be allocating capacity to people who are most willing to pay for it. I think at least one of the things I was wondering about when I was out talking to you and Sean is when it comes to load curtailment, this is a property rights issue in some ways, and having a secondary market for load curtailment really would be easier if we just assigned curtailment priorities. So like if Google's value of not being curtailed is incredibly high, even if you will say you will be curtailed, there should be a secondary market where Google buys out someone else's firm capacity load, uh, capacity rights. And all of these are basically variations of a secondary market or an auction process. And I think I don't have a kind of like psychoanalytic view of why we don't do these things. My understanding is sort of seemingly what yours is, which is that it's political. We've had administrative processes for ages based largely on principles of rate regulation, and things like auction theory have just not been a part of the infrastructure side. It's obviously been a part of like the market design side of things, but it would be better to sort of, as auction theory has become more sophisticated, expand it to the infrastructure parts of the market.
Yeah, that's what Google and the others did in the Rex market, right? That's how you get 24/7 matching is go buy up all the Rex. And so, I mean,
Right.
I'm not opposed to it. I mean, I was a trader, obviously, as capitalistic as it gets. But yeah, then the hyperscalers, you can actually say like, put your money where your mouth is, go do that, and then pay for the system upgrades that need to be dealt with. So yeah, I
Yeah.
like it. I'm excited to see the paper.
Yeah, if you keep an eye out in the next, 2 to 50 months, depending on academic timelines, there'll be something.
Do one on auctioning demand response too, please.
I'd love to talk to you about that if you actually, it's really, yeah. All right, I am now too late for a call, so I'm gonna I know we're editing this, but I guess we've gone over time. I really enjoyed talking with, Brendan, Sean, and Antonio, and I hope this inspired, interest people to have thoughts about load growth. Bye.
Thanks so much, everyone.
Thanks a
Thanks,
lot.
Josh.
Thank you. Bye. Thank you very much.